Tesla just announced that the company delivered over 254,000 vehicles in the second quarter of this year, while producing over 258,000 in the same period. Now, relative to other quarters, this may seem like a negative, down sequentially from the record-breaking 310,000 that the company delivered in the first quarter of the year. And reading the headlines highlighting Tesla's tumble in deliveries, an uninformed person may think that it's all over for the electric vehicle maker and we've seen the peak. We've also heard from Volkswagen CEO Herbert Diess, who claimed that their rival Tesla was weakening and that VW could surpass Tesla by 2025. It seems like a dismal picture has been painted, coupled with low expectations for Tesla going forward. However, the Tesla naysayers may not have much of a reason to be looking at this in such a glass-half-empty fashion. Tesla faced one of its toughest quarters, with the Shanghai Gigafactory being shut down due to lockdowns in China throughout April and part of May, with the need to ramp back up after the factory reopened. This doesn't just affect Giga Shanghai's operations, given that it wasn't just Tesla that was shut down, but all of its local suppliers that also went offline, exacerbating supply chain issues. Tesla's other factories in the United States and in Europe, but their new factory in Germany especially, rely on components from China. Giga Berlin, which just opened a few months ago, doesn't yet make its own batteries and needs shipments from China. Most of the cars sold in Europe by Tesla are also imported from China. So in actuality, taking China offline has a ripple effect that impacts all of Tesla's operations, at least at the present time, while Tesla has two new factories ramping up that rely on the others. Over time, Elon Musk plans to have the Gigafactories produced locally, which not only helps mitigate future supply issues, but also removes the cost of transport over long distances if it's possible for that component to be insourced. So while Tesla delivered 254,000 vehicles, down from 310K, about 55,000 fewer vehicles than last quarter, it's estimated that the Shanghai factory alone, which we've seen being capable of delivering over 70,000 cars in a single month, lost about a month and a half of production. This could mean about 100,000 cars of missed production, and this isn't even factoring in how the shockwave affected Tesla's other factories worldwide. So this has caused a temporary setback for Tesla, but is now in the rearview mirror, with China opening back up again for the time being, but getting back to where they were. Tesla stated in its press release that supply chain issues are still ongoing. However, interestingly enough, the most recent month of June was the best month for production in the company's history. So not only did Tesla get back to where they were, but they surpassed this even at the end of this difficult quarter. Now this bodes well for the future of Tesla. Investors, at least the good ones, are supposed to be looking at the future earnings or cash flows of a company. The entire value of a company is based on the future cash flows, not at all related to the past. And so a one-time hiccup due to external factors should only affect Tesla in the short term, but the long-term trajectory of Tesla riding this massive electric vehicle trend is unchanged. If anything, setbacks such as this end up strengthening the company, which learns from their mistakes and takes actions to mitigate future risk of this happening again. This is actually an aspect that has made Tesla so strong over the years, which is that they've always been up against massive entrenched automakers that have wanted Tesla to fail, or negative press, ancient laws in favor of dealerships, and supply chain problems, especially in a new electric vehicle industry where much of the infrastructure needs to be built from scratch. All of these stresses have forced Tesla to become resilient and nimble, and we see confirmation of this with their rapid return in June, producing a record month for the company. Now this sounds like the opposite of a company that's weakening. However, according to Volkswagen CEO Herbert Diess, Tesla is weakening, and the VW Group must seize the opportunity to capitalize on Elon Musk's woes. Diess believes that Elon Musk must simultaneously ramp up two highly complex factories in Austin and Berlin and expand production in Shanghai, and that will cost him strength. If anything, he should have also mentioned expanding Fremont by 50% as well. Unfortunately for Volkswagen, Elon Musk is not the only employee at Tesla. He's able to multitask at scale because Tesla has over 100,000 people helping him ramp up production. And interestingly, back in March of this year, Tesla had already hired 3,500 people at its new facility in Germany, and by now likely have grown this even further as Tesla strives to hire 12,000 people at Giga Berlin. There's a good chance that many of these workers are being pulled away from competing car makers such as Volkswagen, and so VW is leaking local talent to Tesla. It makes sense that Herbert Diess is trying to motivate his own workforce, but the reasoning does seem a bit unfounded, saying that Tesla is weakening. And that could actually backfire in the medium term quite easily. First off, it's unlikely that many VW employees see that Tesla is weakening as they're competing directly with Tesla now and are watching how quickly Tesla is grabbing share. But even if they see a weakening Tesla due to the reduced sales in the quarter, this will quickly reverse now that Tesla has found its footing with China opening back up. When these Volkswagen workers see massive growth from Tesla next quarter, it could have the opposite effect and hurt morale at Volkswagen since they were expecting to seize this opportunity to surpass Tesla, and instead Tesla moved even further ahead, for which there's a good chance in the second half of this year, a time when Tesla typically does better anyways. Furthermore, these highly complex factories that are weakening Elon Musk are not distractions or side projects. They are literally the core product at Tesla that are focused on expanding electric vehicle reach. If Tesla can get past short-term bottlenecks and disruptions, this new technology, which includes 4680 cells, structural battery packs, gigacastings, and more, will make it extremely difficult for anyone to catch up or be competitive with Tesla in the marketplace. While Volkswagen thinks they are sneaking up on Tesla, they should watch the rest of the 4-hour director's cut, especially the part where Superman single-handedly defeats the entire Justice League. The gigafactories that are costing Elon Musk's strength are designed to crush Volkswagen and others and will actually bolster Tesla. Even Herbert Diess admitted last month that he didn't expect Tesla to be so fast and well prepared. It seems like Tesla is the one sneaking up on VW. And the evidence has been showing up in the numbers. In the United States, most automakers saw negative growth except for Tesla, which grew at over 50%. Volkswagen brand's second quarter sales were down an astounding 34% in the US. How exactly is this sneaking up on Tesla? Perhaps even Tesla didn't expect their competitors to do this poorly. And surprisingly, VW's electric vehicle, the ID.4's US sales, dropped an insane 71%. The supply chain woes are hitting everyone else even harder than Tesla. In the second quarter, Tesla's aforementioned sales were 254,000, which is still up from 201,000 in the same period last year. Tesla is constantly ridiculed and doesn't get nearly enough credit for their next-level execution in managing risks at the company. Although the supply chain problems may alleviate, it's more likely that they'll shift to other parts of the EV business over the next few years. Elon Musk has spoken about the chip shortage issues getting better, but then battery supply will be the next bottleneck. The electric vehicle industry will face growing pains for many years to come, and Tesla has demonstrated multiple times now, especially in the most recent downturns, that they're best prepared for what's coming. And before I continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Now, although Tesla has made quite the comeback this quarter in terms of deliveries and saved itself from potentially being much worse, Tesla will still have a challenge in beating the earnings. They did have a quarter last year that had similar number of deliveries. In Q3, Tesla delivered 237,000 cars and ended up making $1.86 per share. This quarter, analysts are calling for $1.98 in earnings, which is 6% higher, but they did deliver about 7% more cars. So very roughly, this would put them on track for an earnings beat if we looked at just deliveries as the only input factor. However, the dynamics of the EV business have changed dramatically since last year. Vehicle raw costs have skyrocketed, and Tesla has been increasing prices in order to keep up. Tesla has also added 2 new gigafactories into the mix, which are not yet at volume production, and so these will insert added expenses for the company. Even Elon Musk has called them giant money furnaces, and he said they're losing billions of dollars. And so even if Tesla delivers slightly more cars compared to that similar quarter from last year, they now have twice as many factories, more employee salaries to pay for, etc., that will add increased costs with not much increase in revenue yet. There's also going to be a large impairment charge given that Tesla was down big on their Bitcoin stake on their balance sheet. According to Gary Black, who's been tracking this closely, if Bitcoin fell below $30,600 in the quarter, they would have to begin taking an impairment charge for anything below that value. And indeed, the lowest Bitcoin price at the close in the past 90 days was actually $17,744. And so according to Credit Suisse, this would result in quite a significant $475 million write-down, which is about a 45-cent loss per share, and could cause Tesla to miss the estimates. Of course, this is a non-cash, one-time charge that investors should look past, but it will follow Tesla in the media headlines and in the earnings numbers throughout the year until they can replace it with next year's quarterly results. But although Tesla will likely disappoint Wall Street on earnings, the business itself should kick into high gear in the second half of this year, as all 4 of their main vehicle-producing factories will be fully operational. So do you think that Tesla is the one that's weakening, or is it the other legacy automakers, including Volkswagen, whose CEO believes he can sneak up on Tesla to surpass them in under 3 years? And how do you think the investment community will react to Tesla's reported earnings later this month? Will they look past one-time issues, or will Tesla stock be knocked down even further? Don't forget to watch my last video on the competition that's coming for Tesla, or vice versa. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.